morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some financial results of those Canadian-owned but regionally operating banks, Scotiabank Trinidad and Tobago Limited, as well as FirstCaribbean International Bank, recently rebranded to CIBC Caribbean for their fiscal half-year periods ended April 2024. Now, both groups would have reported improved earnings. Let's take a look at how that stacked up and what investors might expect in the coming months ahead. Turning firstly to First FCI, the group would have reported an earnings per share figure of 63 cents per share, a 4.4% odd increase from the 60 cents TT equivalent recorded in that prior comparable period of half year 2023. Driving that performance was an improvement in revenue of just about 1.8% from 2.45 billion equivalent TT to just up under 2.5 billion TT equivalent. Operating expenses also up 3% from 1.4 to 1.45 billion. There was a big swing in terms of credit losses and expenses on financial assets from 42.8 million to a release of $66.6 million. Overall net income attributable to equity holders improving that 4.9% from 947 odd million to just about 993 odd TT dollar equivalent million dollars. So good news there for FCI investors. When we take a look at the performance in terms of revenue composition, we can see that the revenue increase was largely driven by that improvement in net interest income, which was up roughly that 1.8% from 1.748 billion to 1.779 billion TT equivalent, with a modest increase as well in other operated income from 711 million to 716 million, roughly 0.7%. So reasonably, we could say that there was a very modest increase overall in revenue to relatively stable revenue, cognizant of the higher interest rate environment, particularly in the US dollar space. Now, in terms of profit before tax performance by segment, we can see that there was pretty much good performance across the board with the exception of wealth management. Corporate and investment banking in that blue segment up just around 9% from 837 to 913 million. Retail business and international banking up 23 odd percent from 107 million to just about 132 million, with a modest decline in wealth management slipping from 38 million in terms of profit before tax contribution to just about 34 million in the most recently concluded fiscal period. Now, at a price of just under $7, $6.94 to be specific, FCI is trading at a price to earnings ratio of 6.1 times, which is well below the sector average of 12 times and offers investors a fairly juicy dividend yield of 4.8% compared to what is still a fairly healthy sector average of 4.2%. Of course, the one kicker for FCI is that it does pay its dividends in US dollars. So with that stable to modestly growing revenue in mind, those relatively attractive valuations compared to the banking sector and that US dollar dividend payment, of course, in an environment where it is quite attractive to be investing in an asset that you pay for in TT dollars and get US dollar cash flows versus maintaining an overweight rating on FCI for the time being. Turning quickly to Scotiabank Trinidad and Tobago, SBTT, the group would have reported an earnings per share figure of $1.84, a 3.5% increase from the $1.77 per share recorded in that prior comparable period. Driving this performance was a pretty decent increase in net interest income, up around 5.9% from 662 to just over $700 million. Total revenues climbing just at 3.6% from 926 million to just over 960 million. Ultimately, profit after tax climbing 3.5 odd percent from just about 312 million to $323.5 million there. So again, good reading for Scotiabank investors as well. Looking at that revenue composition, we can see that net interest income climbed from 662 to 701 million at 5.8 odd percent, with other income experiencing a very modest decline from 264 million to just about 259 million. Ultimately, again, momentum in that net interest income segment driving that overall revenue higher. From a valuation perspective, when we take a look at Scotia and compared to the rest of the banking sector, we note that it is trading at the higher end of the spectrum in terms of price to earnings ratio, meaning investors per dollar earnings generated by Scotia are paying relatively the most when compared to the other members of that banking sector. FCI, in fact, as we mentioned earlier, on the other end, of the value spectrum at around 6.1 times the cheapest stock by this particular multiple. And when we take a look at banking sector dividends on average, again, that 4.2 odd % average dividend yield, Scotia is at the relatively lower end, and we see that relatively given that most of the banking sector stocks, with the exception of NCBFG, are in excess of a 4.3% dividend yield, with First Citizens Financial Holdings at around a 5% trailing dividend yield at this particular point in time. So at a price of $66, again, with that trailing price earnings ratio of 17.5 times, which is above that sector average of 12 times, and with a dividend yield which is pretty much in line with the banking sector of 4.3%. Looking at those increased revenues, the consistent dividend payment history of Scotiabank, but those elevated valuations, Bourse is maintaining a market weight ratio on Scotia for the time being. But that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until we meet again, enjoy the sports. Heartbreak for West Indies fans, but there's much more to look forward to. Copa America, etc. And stay safe, happy investing, and we'll see you again on the Bourse Report.